Welcome back to another lesson. In this video, you are going to look at an exam that was done in June 2021, Rchrp Introduction to Financial Accounting. And our focus is on question number 1. And the question reads that the following balances were extracted from the books of two traders for the year ended that 1st December 2020. You have sales returns, inventory as per 1st January 2020, that is opening inventory. We have purchases, we have sales, salaries and wages, repair and maintenance, purchases returns, office expenses, electricity, carriage inwards, bad debts, rent, interest received. Additional information, you are told that inventory as at that 1st December 2020 was Kenya shillings 700,000. That is the closing inventory. Then amount unpaid as at that 1st December 2020, you have, these are arrears, outstanding expenses. We have rent 90,000, we have electricity 40,000. Then Roman 3, you are told that depreciation is to be calculated as follows. Motor vehicle should be depreciated at 25% at cost, furniture 12.5% at cost. And the cost of motor vehicle was 3,506,000, while that of furniture was 4,800,000. Both the motor vehicle and furniture were acquired 2 years ago. The year 2020 is the 3rd year. Now, other balances that were brought forward as at January 2020, we have debtors. This is supposed to be 1,870,000. We have bank, those bank figures there is missing. Yeah, this figure is supposed to be capital. We have 4,700,000. Then we have cash. Cash is 285,000. Then we have dividend received. Dividend received is 155,000. So you are required to come up with the income statement. You are required to come up with the income statement. The figures here for this figure here for bank is 1,605,000. This figure for bank here is 1 million. This is 1 million. This is 1,605,000. That is the figure for bank, 1,605,000. And the debtors, this is 1,870,000. This is 8. This figure here is 8. It look like a dollar sign. That is 8. Now, we are required to come up with the income statement. But before we get to our income statement, we need to do some workings. Let's have some workings here. The first we shall look for is depreciation. Depreciation, we are told that from the question that motor vehicle and furnitures were depreciated at cost. So we need to look at their cost values, then multiply by the rate of depreciation. Motor vehicle is 3,506,000 at 25%. So here we need to find 25% times 3,506,000. We look at this because these depreciations are expenses and we need to get their figures. So 25% times 3,506,000. This gives me 876,500. This is on motor vehicle. Motor vehicle. Let's look at the furniture. The furniture is 12.5% times, what is the figure for furniture? 4.8 million. 12.5% times 4.8 million. So if you find this 0.125 times 4.8 million, it gives me 600,000. Now, that is it. Something else we need to work on is on accrued expenses. Now, you see, expenses have debit balance. Here we have rent and electricity. So if you see the rent account, and also the electricity account, the figures that were paid were, that means what was paid here. If you go to rent is 150,000, electricity is 320,000. So these figures were paid with respect to bank. So in the accounts, what is appearing there is that you had bank that paid 150,000, and also you had bank that paid 320,000. Yeah. From the statement information provided here, the rent 150,000, electricity 320,000. But there are some other expenses that were not paid at the end of the financial year. But remember, expenses are recorded when incurred, not when paid. It therefore means this one needed to be captured. Therefore, we are going to record this as accrued expenses. So you are going to create an accrued account, accrued expenses account, and accrued expenses are liabilities. They are short-term or current liabilities. Therefore, we are going to record rent, and rent is 90,000, electricity 40,000. In our accrued expenses, we are going to have rent 90,000 and electricity 40,000. Then we debit their respective accounts. Since we have credited this one, rent, we are going to debit 90,000, and bank, this is with accrued account, and then here you're also going to credit accrued account with 40,000. So now the balancing figure, which now go to income statement, this is 360,000. Balance carried down 360,000, and this will give you 360,000, and this one is 240,000, and then balance carried down 240,000. So here you have 240,000. Now with this accrued, we are going to take this one as current liabilities. This is 130. Is going to be captured as current liability. Balance carried down 130. So this gives us 130. Now let's see if there is anything else that needs some adjustments. If you look at the rest, the other information here, they don't require adjustment, because what you have here is the opening inventory, the closing inventory, and other balances. Now let's now go straight to our income statement. We go to our income statement. Now the name of this business is, what is the name of the business? Is called Watume Traders. So we are going to have Watume Traders, Watume Traders, income statement for the year ending 31st December 2020. So the year ending that 1st December 2020. The first item that appears in an income statement is sales. You bring in the sales here. The sales from the sales here is 9,538,000. The sales 9 million. I'll create column here and this one 9,538,000. Now, from the statement there, we have sales returns. We call them returns inwards. Returns inwards. These are the sales that were made but returned by customers. It therefore means they reduce our total sales. So how much is the figure? This is 338,000. You come here and reduce your sales with 338,000. 338,000. So you shall have what we call net sales. Net sales, and this is 9,200,000. When you do your subtraction there, that is 9,200,000. Now, after this, what we need to do now is to find or to proceed to cost of sales. Cost of sales. In the cost of sales, we need to identify the opening inventory. Opening inventory. Opening inventory appears in the trial balance or in the information provided. Here we have opening inventory, that is inventory as per the 1st January 2020, 984,000. You bring it here, 984,000. 984,000. Then you look for purchases. How much were the purchases? Let's check from the question. Purchases. You look at the question. You have purchases is 4,300,500. Purchases, we have 4 million. We have 4,300,500. Were there purchases returns? Purchases returns, they reduce purchases return. Were the purchases return correct? Purchases return 400,000. They reduces your net purchases. This one you subtract. As we did with sales returns we subtracted, or returns inwards. The same happens here. Purchases returns we subtract. That is 400,000. Now, you look at this information here. You are told that we have carriage inwards. After purchases returns, we have carriage inwards. Carriage inwards, these are expenses that are incurred to bring goods or to bring purchases to your warehouse. So those expenses, they are brought in here. Carriage inwards. They are expenses incurred to bring your goods to your carriage inwards. The expenses incurred to bring your goods to your warehouse. So therefore, how much are they? Carriage inwards in this case is 267,000. Bring them here. 267,000. 267,000. Finally, we subtract the closing inventory. Closing inventory. Closing inventory as it appears in additional information. Closing inventory was 700,000. 700,000. 700,000. This one you subtract, and we bring the net figure here. So let's do our calculations here. 984,000 plus 4,300,500 minus 400,000 plus 267,000 minus 700,000. This will give you 4,451,500. The cost of sales. Therefore, this one we are talking about, these are the costs incurred to make your sales there. So in other words, we subtract them so that we can get our gross profit. Gross profit. So we take our 9,200,000 minus what we have here. And this gives us 4,748,500. Now, having obtained your gross profit, you need to look for whether there are other incomes. Other incomes. Incomes that are not directly related to the business. If you look at the statement here, you have what we call interest received. These were interest perhaps from deposit with banks. These are interest received 205,000. 205,000. So interest received is 205,000. You also have dividend received. You see, dividends, if they are received from these dividends are not final tax. They are not. They were not tax. They are not. The tax incurred on them are not final. Therefore, they can still be taxed again, especially if they are coming from what we call this. What we qualified, if they are qualified dividends, then so in this case you are having this dividend received, the other incomes, you come and bring them here. So we have dividends received. Dividends received, that is 155,000. So here we shall have our net gross profit here. So 4,740,500 plus 205,000 plus 155,000. This give me 5,108,500. Now we are done up to that point. The next thing now we need to do here is to come or look at the expenses. Expenses that are related to business. We call them allowable expenses. They are expenses which may not be allowed. In this case, we are going to have our expenses. Let's start from the top. Salaries and wages. These are our allowable expenses. So we have 1,051,500. So salaries and wages. We have salaries and wages. These are allowable expenses. That is 1,051,500. Any other expense from the top? Start from the top. We look at any other expenses here. We have repair and maintenance, 700,000. We come and bring it here. Repairs, repair and maintenance, 700,000. Let's look for another expense starting from the top. We have repair and maintenance. That's okay. Office expense, 375,000. That is allowable. Office expense. We have office expense. Office expense, 375,000. Let's move on. Another expense from the question. Let's check which expense we have. We have electricity. But remember, this electricity had adjustment from the workings. So we bring the net figure here. Electricity had some adjustment. Electricity. Check our working and we bring this as 360,000. We move on. Any other expense? Here we have bad debts. Bad debts are 55,000. This one they are allowable. Bad debts and also rent. So bad debts here is 55,000. And then we also have rent expense. Rent expense, there was an adjustment. We made an adjustment of 90,000. So this gives us 240,000. Now, I also want to mention something here. You see, when this part here, the carriage inwards and there is carriage outwards. When you are given carriage outwards, those are allowable expenses. You see, these are expenses which are incurred to carry goods to your customers. So those one, they are allowable expenses. But carriage inwards, you consolidate them to purchases. Therefore, at this point on top here, I don't see any other expenses because I've already captured bad debts, I've captured rent, interest received. Let's go to the additional information. Here we have depreciation for both motor vehicle and furniture. We calculated that from this working. We come and bring it here. Depreciation here for motor vehicle was 876,500, and depreciation, this is for motor vehicle. Then we have furniture depreciation is 600,000 from the workings. Bring all these expenses here. Let's add them. We have 1,051,500 plus 700,000 plus 375,000 plus 360,000 plus 55,000 plus 240,000 plus 876,500 plus 600,000. This gives me 4,258,000, and these expenses you subtract them from the gross profit, net gross profit. You take 5,108,500, 1,508,500, subtract, and you get your net profit now. Your net profit becomes 850,500. That is it about the income statement, and we are done with that part. We move on to the next. You are told to prepare the statement of financial position. So we look at Watume traders. Statement of financial position. Statement of financial position. Statement of, talking of Watume traders, statement of financial position. Statement of financial position as at. Remember, this one is happening at particular incident, as at that 1st December 2020. because the statement of financial position changes. If some of the items you find here, if you prepare a different date, then the items will have changed. If you look at things like depreciation and the rest. So it is as at the 1st December 2020. So here we have the item, then we have the costs, we have accumulated depreciation, and net book value. And sorry, these items are for, we start with non-current assets. We start with non-current assets. Non-current assets. Non-current assets, that's where you begin with the item. We have the costs, accumulated depreciation, and then net book value. Now, the first non-current asset here we have is motor vehicle. Motor vehicle. It had a cost of 3,506,000, and the depreciation which we have captured in our here, the depreciation here in our income statement, 876,500. Remember this depreciation of the third year. It therefore means, and it was constant because it was 25% on cost. So it means if I multiply this one by 3, I will get the accumulated depreciation for 3 years, which is 2,629,500. Then I take the costs. Minus the accumulated depreciation. It will give me the net book value, 876,500. Now, another non-current asset here we have is furniture. Furniture, we shall have the cost, which is 4.8 million. Then depreciation was 600 times 3, 600,000 times 3, 1.8 million. And the net book value of furniture is 3 million. Then we go to current assets. Current assets. I don't think I have any other non-current assets. Current assets, we start with inventory. And inventory here, we are considering the closing inventory. Inventory, that is 700,000. We have 700,000. We have debtors. Debtors as they appear is 1,870,000. 1,870,000. I want to look at this point clearly here. If you look at this information, you are told other balances brought forward as at January. This January, you had a debtors of 1.8 million, but in the course of the year, you incurred bad debts of 55,000. This one, they should reduce your debtors. So you come here, you make adjustment of bad debts. 55,000, come and adjust your bad debts. Debtors, then there is bad debts. I want to put it here so that it become clear. Bad debts of 55,000. You subtract this one so that you get the net debtors. Because this one were not the closing debtors. These were the opening. So you have to capture the debtors, the bad debts that were incurred. We move on. There was bank. Bank was 1,605,000. 1,605,000. This is 1 million. We come here, we have bank. Bank is 1,605,000. Then we have cash. Cash is 285,000. I don't think I have any other debt, current asset. Let me check. Let me check. Do I have any other? There's no any other. There's no any other. There's no any other current asset. Yeah, we have cash, bank. That's okay. Now, once we are done with that part, we move on to current liabilities. So let me first of all get these totals here. Let me get these totals. This is 700,000 plus 1,870,000 minus 55,000 minus 55,000. This is plus 1,605,000. 1,605,000 plus 285,000. So I can talk of the total current assets here being 4,405,000. Then I have to less current liabilities. Current liabilities. Current liabilities. With the current liabilities, you have to consider the accrued expense. Accrued expenses were first current liabilities. That is, we had accrued expense for rent and what? And electricity. Yeah. We had accrued expense for rent and electricity. So we add them up. So we have that was 90,000 plus 40,000, or I just list them here. Accrued expense here we have rent, which was 90,000, and then we have electricity, which was electricity was 40,000. 40,000. Then with any other accrued expense, we have creditors. Creditors, we have 3,533,500. If you go to your statement here, or to the question, you'll find that the creditors were listed here. Creditors 3,533,500. What else do we have as apart from creditors? We have. Do you have anything else really? Let me check again from the question. Do you have anything else left as current liabilities? Looking at these other balances, there is nothing here. Additional information, there is nothing here because we have already captured these unpaid expenses. If you look at the statement here, accrued, what is this? Current liabilities, we don't have anything. So we can clearly see that we have captured all the current liabilities. So get their net values here. So I have 440 minus 130,000 minus 3,533,500. So what I'm bringing here is 741,500. These ones, they are going to give me what we call net sales. Net sales. Not net sales, sorry, net assets. I'm sorry for that. This is going to give me net assets. Net assets. Can we add them? We have this plus 3 million. This plus 3 million. Then plus 876,500. 876,500. This gives me what? This is 461. This is 461, 4,618,000. Let me do it again. Let me do it for avoidance of doubt. Here we have 741,500 plus 3 million plus 3 million plus 876,500. It gives me 4 million, and these figures were obtained from having the fixed, the non-current asset plus current asset minus current liabilities. Now, let's see what finance our assets. We now look at finance by. Let's see. This was 4 million. 4 million. There is 4,016,000. Okay. Let's look at the other category, financed by. Financed by. What finance our assets or Watume traders asset? Financed by, we have capital. We have capital, that is 4,700. I don't know why this one has started behaving this way. Let me check. This is 4,700,000. And then we have what else? What else finance this? You can also talk of net profit. Net profit of 850,500. 850,500. So that is it. That's how we prepare the we prepare for 700,000 plus 850,500. So that is it. That's how we prepare our. That's how we prepare the statement of financial position. You see, when you're preparing this one, I've prepared this as per the International Financial Reporting Standards. But there is an old style where people used to prepare having non-current assets plus current. You first add non-current asset plus current assets. Then you compare them with capital and liabilities. Well, but you see, when you have current assets minus current liabilities, this one they give you what we call the working capital or the working assets. So in this case, when you subtract them this way, you will get what we are calling the working capital. The working capital plus fixed assets, it gives you what we call the net assets. Otherwise, that's the end of this lesson. We stop there for now. Goodbye.